Hello, and welcome to the first Astute Wealth and Health podcast. First and foremost, I'm delighted to introduce both our host, Ben Young, founder of Astute Wealth Management. Ben's guest, Kim Arthur, has led the San Francisco-based Main Management through an outstanding period of growth during the past 2 decades, and today is regarded as one of the nation's premier providers of investment management services to institutional and high net worth clients. Kim has been recognized by Institutional Investor magazine as a rising star, is a regular speaker at leading investment industry conferences, and is often quoted by the most revered financial media. More can be read about Kim and Main Management at www.mainmgt.com.
So let's get right to it, because I have lined up some good questions and topics I think are very relevant. When did you start with Main Management? When did Main Management start? How long have you guys been doing this?
Yeah, so we started the firm in 2002, so just over 20 years ago. And we decided at that time we would exclusively use exchange-traded funds to get our exposure or to build the strategies for clients. And today we've got a team of 22 people, and we run about $3.5 billion.
Wow. How do you or how does Main Management define the market? When people talk about the market, what does that mean to you?
Yeah, great question. First of all, Ben, wanted to, again, thank you for the credible partnership between our firms. It really is an invaluable partnership that we continue to grow. So love being able to be part of the solutions for you and your clients that you do a great job with. So you're right. The market means a lot of different things to many people. For us, we focus on the liquid, publicly traded markets. And so what do I mean by that? These are securities, these are stocks, they're bonds, they're exchange-traded funds. They're all readily available on listed exchanges like the New York Stock Exchange or the NASDAQ that people have heard about. And that's our primary focus, is to be able to try to sift through all those opportunities in those liquid, publicly traded markets, and then hopefully try to find the best ones and the best outcome for clients.
Thank you. Maybe elaborate a little bit about some of your strategies and ETFs that you guys utilize.
Yeah. Let me I want to walk back and go back 20 years, and I'll make it quick here. But 20 years ago, if an institutional investor, Fidelity or a big institution, they had the ability to get inside information. They could call up a company like Cisco and say, what's your quarter look like? Oh, it's going to be better than expected. I'll buy more stock. Totally. There weren't rules around that. It's like hard to believe that. But after 2002 and the great crash from the internet boom, rules changed. And it became a level playing field. And that's right when these exchange-traded funds took off. And these ETFs, they're basically baskets of individual stocks that have been wrapped around, and they give you sector exposure, size, or style if you want growth or value. And again, I go back to that level playing field. Being an individual stock picker, these institutions, when there was inside information, they had an advantage. Now that advantage was gone. Everybody had this level playing field. And the second thing that the ETFs did is they enhanced what mutual funds had been around since the 50s, and they made them cheaper and tax aware. So those are some big reasons, and that's why that industry has gone from 100 billion to 8 trillion today.
Wow, that's impressive. So a lot of the listeners, there will be some sophisticated listeners. There will also be some that really probably need it broken down on simpler terms. We use words like ETFs. Again, those are just, in essence, a basket of stocks.
Exactly.
Or sectors. What is a sector?
Yep.
I mean, people might hear that and they might not immediately go to what we go to as a sector.
That's a great point there. So the U.S. economy in the stock market is broken down to 11 broad-based sectors. The biggest is technology. That's over 30%. And then you have other sectors like healthcare, which is about 15%, financials, which are about 12%, consumer discretionary, which is about 10%, and that includes retailers that people would be familiar with. So they try to bucket it into different parts of the economy that people can identify with. But there's 11 of those broad-based sectors.
I like how you said try, because you have a company, we all think of Amazon, it's like a shipping or store. They're not under the bookstore sector anymore. Would they be a tech company? I mean, they have streaming. What kind of, where do they fall in
Ben, you just nailed it. And that is so good, because when most people think of Amazon, they think of technology. They think of, very efficient delivery, very efficient, logistics. But it actually is bucketed under that consumer discretionary, along with, ready for this, Tesla. So there is there's some people behind the curtain that get to have some flexibility on what they choose. In the technology, your big ones would be Apple and Microsoft. And then under the communications, your big ones would be Meta and Google.
So if you're a lay investor and you're investing on your own and you're like, I just want to own some technology, you may not necessarily get what you think you're getting.
That is exactly right, because you would, if you just went in and you bought a technology ETF, you're going to miss out on, like you said, Amazon won't be in there, Tesla won't be in there, Meta. So you are 100% right. Our process is what I like to call, sounds like it's some sort of a medicine you would buy over the counter, GARP. That's growth at a reasonable price. So what it means is you're trying to find value where there's more upside than downside based on history. So probably no different than when people are looking to buy a home or they're looking to buy a dishwasher, some item. They have to have some history on what that item, should have been priced. And if all of a sudden Best Buy says, hey, we got the washer you've been looking at there, 25% off sale, you might say, I think I'll go buy it because I happen to need it. So we look at a lot of history. We try to find things that have become cheaper than what they historically should be selling for. But then you have to have a catalyst. You need to have some reason why it's going to become more worth, a bit more expensive or priced better, because you don't want to end up with the buggy whip, right? You don't want to end up where it's 1915 and you're like, I'm buying buggy whips. And it's like, the buggy whip's gone. Ford has created this thing called an automobile, and you don't need a buggy whip for it.
Well, that's great. I love that analogy. So if I were to, bring up a name of a particular stock that most people never heard of before. I mean, I've known about it a long time because I love technology, but NVIDIA.
Yep.
Now I have average clients going, what's this NVIDIA? And that's a stock that's up like from the bottom, it's up over tenfold from where it hit just a little over a year ago. So, when you're talking about value and looking for things that are priced, how do you deal with something like that just has had the momentum blow up that it's had?
Yeah, that is a wonderful question. So if you look at the market over the long time, the market, again, like we were talking about, in this case, we'll use the S&P 500, okay? The top 500 companies that are out there in the U.S., these are very well-managed companies. That trades at what's called 18 times price to earnings, okay? So just not to get too confusing, but just to kind of focus on the 18, okay? You get something like NVIDIA. NVIDIA trades at 39 times, okay? Some people might say, oh my gosh, Ben, that's really expensive. But you know better. You have to look at some of the other metrics. You would say, well, wait a minute, it's 39 times, but the revenues are growing at 100+%, where the S&P at 18 times, the revenues are only growing at about 5%.
Which is why in your portfolios, you're not going to find a bunch of stocks that are $1 or $2 or $3 a share. You're not looking at the price per share. You're looking at the value or attractiveness of a company based on how much business they're doing and what they're going to be doing in the future and where they're at now.
Exactly.
No, I love that. That's great. Let me, I think that I could keep talking about stocks with you all day long, but I think my clients want to hear some other topics
Sure.
that I would love to cover. And if we have some time, we can go back deeper into valuing stocks. But, one thing that is on top of everyone's mind, obviously, is the election coming up. And I'm sure you get asked this quite a bit. The country is deeply divided. I think we just had an election, or not election, I'm sorry, debate.
Debate. Yeah.
And what do you think this means for the markets?
Yeah.
And how does that play into your investment management?
Yeah. So if we kind of look back 6 months ago when we started the year, most people were expecting, like you said, they're like, it's an election year. There's a lot of uncertainty out there. Most Wall Street strategists thought that the equity markets would be up less than 5%. And they were probably more, and individuals too, were probably more keen on buying what they thought was a sure trade with fixed income. They thought fixed income is safe. I can get 5+% in 12 months on it. And the equities, I'm not quite sure about it. So if we fast forward here, today, the complete opposite has happened. Fixed income has delivered 0 if you're not in cash. And equities are up 15%. But guess what? Going back again to history, if you use history and 6 months ago you said, what happens in a bull market, because we are in a bull market that started in October of 2022, what happens in a bull market in a election year, which is called a fourth-year presidential cycle? And you know what, Ben? The market's done exactly what history says it would do. It's up more than it would be. It's up 15%. But the pattern of that increase, it looks exactly like a normal bull market presidential cycle. So once again, history can confound people, and people like to say, well, yeah, I know that. I always like to say history doesn't repeat, but it definitely rhymes, and you need to be aware of that.
So with people sometimes with their different politics,
Yep.
And obviously we love to just put people in one or two categories, but there's a lot of variety of beliefs that kind of cross over. You have people say, well, shoot, if their guy gets elected, I'm out. I'm getting out of the market. Or if my guy gets elected, things are taking off. The economy's going to be great. And I often think there's a lot of variables here. And what do you see post-election? What do you see? What should people be aware of when making those kind of general assessments?
Yeah. So couple things. One that I would look at, again, let's go back to history. What happens in the first year of a presidential cycle? That would be 2025, okay?
No matter what side gets elected?
No matter what side gets elected. The average return is about 6%. So it is a lower return than the historical 9 to 10%. And part of that is because this year is a much higher return. So you get kind of a slowdown there. So that's kind of the first thing there. People can break it down between the Democratic Party and the Republican and, who controls the House and the Senate. There's a lot of permutations. But in general, it's better just to say kind of like a mediocre year for next year, a 6%. The second thing that you look at that I focus a lot on is people get very, very caught up in the federal government and in Washington, D.C. They forget that 85% of our economy is run by people like you, the business that you build, the people that you hire, the things that you do. And that is not as influenced by Washington. They can play around with regulations and taxes and whatnot, but overall you find a way to kind of continue that American exceptionalism and find ways to make things better. So that's what I think people forget.
Well, and also having, the Fed does control monetary policy to a certain extent, and so maybe that's their biggest arm in this whole thing. But where rates are now and where they might be in the future, I mean, it probably plays a pretty big role into business. And so with rates going up, why is business still so Good. I mean, people are borrowing at much higher rates than they probably used to.
Yeah, that's a great question. Again, we're going to go back to history. I know people are they're like, well, this isn't a history lesson, but it's like life. There are lots of analogs that you can look at. The rates right now, let's use the 10-year. That's the one that mortgages are priced off. It's one that most people, if they're looking at a rate, that they'll kind of focus in. The 10-year Treasury is 4.25%. Anytime it's between 4 and 5%, which, oh, by the way, that's actually below its historical level. And this is key to keep in mind. People have a recency bias, and they're like, oh, I remember when the 10-year was, rates were 0.5%. That was not the normal. Okay, that whole period where they had ZIRP, zero interest rate policy, not normal. Historically, that 10-year has been closer to 5%. That's why businesses are doing exceedingly well right now. This is a normal environment for rates. And what it means is well-run companies that have cash flow that they produce, just like an individual family, if they have excess cash, they can earn 5+% on their cash risk-free. So that is why it's a normalization of rates if you take that recency bias out. And it also means that multiples on the market, they typically half the time are over 20 times when rates are between 4 and 5.
Right. So, no, that's great. I appreciate you sharing that. I guess if I were to think about the average family out there, there's a lot of jobs opportunities, but these aren't necessarily jobs that are all for people raising families. They seem like a lot of lower end service type of jobs, help wanted signs for restaurants and or shops, retail. And at the same time, you have a lot of companies with AI, which I want to get to talk about a little bit. What does it mean for the economy when you have, and from your standpoint, you hear about people being laid off from tech companies, high-paying jobs, and then, of course, all these jobs available and high job numbers on maybe lower-end jobs. Is that something to worry about going forward, or is AI going to solve all of our problems?
Those are great questions. So if you look at the wages, and like you said, if you break wages down to lower wages versus the tech companies that are paying higher wages, actually the past 3-4 years here, the lower wage growth has been significantly higher. Okay, you got here in California, right, at fast food restaurants, they're paying $22 an hour. They got a minimum wage that they kicked in there. So that low end has actually had a big catch up here during the last 4 years, where the high end actually hasn't had that same type of thing. But what's key, again, you have to kind of look at a composite of the average. If you look across the average, real wages are up 3% year over year. And I say real, that's after you adjust for inflation. So taking aside the inflation there, that is why the economy has continued to be fairly robust, because you have only 4% unemployment and real wages are positive. That gives people more spending money. Now, what that doesn't fully address is what you were talking about, like inflation has really, like cumulative inflation since the beginning, since, pre-COVID, it's up 25%. So prices on average are up 25% more. So that you're going to need this continued real wages for people to be able to have money to go out and spend. But it is happening.
So thanks you just transitioned into inflation, which is something I also want to talk about, because you brought up earlier that the market S&P will just be, say, the S&P 500, because we know the S&P 500 doesn't make up the whole market. Right. There's a lot of pieces, but it's large companies in the U.S. The S&P trade, you said, at an 18 times multiple currently. When you and I talked, I think it was last August, the S&P was at 17. Yep. And we were talking about whether that was expensive. Now we've seen the market run more than 25% maybe since October, maybe 20% since August. we have only moved from a 17 times multiple to an 18. Is that inflation happening in the market? How it's not just growth; it's just inflation is maybe kicking into the stocks.
Yeah.
At
So
some point.
a quick clarification: when I mentioned 18, I said that was the average over time. It's currently actually 20 times. So
Okay.
So there has been a jump up since you and I talked from 17 to 20.
So it's not all inflation.
It's-
There's real growth being realized or being priced in.
Priced in, exactly. And what typically happens is the start of bull markets, you usually start them from 10 times, 15 times. This one started from 15 times because the earnings didn't collapse as big as they did back in 2008 and 2009. And the first leg of a bull market, that would have been 2023, you get the multiple expansion immediately. It goes from 15 to 20 times immediately. This year, in the middle part of a bull market, the earnings catch up. So the earnings are exploding right now. These big companies, those S&P 500 companies that you talked about, they're getting very efficient with they've cut headcount out, they've cut expenses out, and revenues are still growing. And this is with inflation having come down. Right? Inflation was 9% in 2022. We're down to 3% or a little bit below that. So they're just firing on all cylinders, and it goes back again to those consumers that have real wages that are up. They have more money to spend. So I think that it is, and that's why we're not cheap on the market, but there have been half the times when interest rates are where they are right now that you've had this type of a multiple. So it's not unusual.
So now that I've pretty much lost maybe half the audience
Yeah,
talking
sorry.
about, no, it's not you. I brought it up.
Yeah.
Multiples on the lowest end.
Yep.
You know, when the market was maybe the bottom of 2009.
Yep.
We
10
hit single
times.
digits.
Yeah,
didn't
we were basically
Barely?
10 times. Yeah,
okay, 10 times. And
yeah.
on the high end before 2007,
Yep.
what was the multiple at that time? Wasn't it like a 30?
Well, the highest it's ever been, and I like looking going forward, it was about 24 times in 99 and 2000. That was the high. So at 20 times, we're definitely up there in rare air, but it can continue as long as the earnings. The key piece again is, do you have growing earnings? If there's no earnings growth, we're in trouble. We're in trouble. But if the reason why you would have no earnings growth is if we have a recession and the consumers, they stop having real income gains and they stop spending. Then we got troubles.
So just a quick plug for
Yep.
the fund that
Yep.
one that I love the most with you guys, and I know you have a variety of
Yeah.
options, but is the sector rotation
Yep.
fund, which I've been very happy with. You guys have some leeway on how invested in the markets you want to be. It's not just sectors, but you guys can pull back the reins if you feel like there's an opportunity to take some profits.
Yep. That's
Yeah.
exactly. And we're actually right now, given where the market is, we think there's probably a little bit of a pause time. So we've gotten a little more defensive here for the next few months here because of the big run up and the current valuations. Does not mean that we're not still bullish long term.
You still hope things go up.
100%.
Yeah.
We just think that there's sometimes those, things usually they don't go straight up forever. There's stair steps and pauses and zigzags. So, and again, it goes back to some of the things that you talked about here that you still have the Fed that you have to worry about what they're going to do. You do have uncertainty around the election, even though historically it doesn't matter. It does short term. So yes, to your point there on that sector rotation, we're a little more defensively positioned here in the near term.
So just a quick
Yep.
shameless plug for myself. If you want the sector fund, it is available on most platforms you can trade.
Correct.
But you should be buying it through me.
Yeah, I would agree 100%. You want to definitely have Ben, your advisor, go to there. That's the person you want to rely on. Couldn't agree more.
All right, thank you. I like to think that I'm humble, but I'm also always looking for an opportunity.
I
as well.
love it.
All right,
as
so,
you should.
So talking more about inflation, people might curse me for not bringing it up, but gas prices.
Oh.
If you go back to 1981 and you were to look at inflation, we'd probably be at $2.42 is what I read in 2020. I know that's a little bit old, but I mean, we're not there. We're much higher than that.
Yeah. Yeah. And obviously, I affectionately like to say you and I live in the People's Republic of California. So gas prices here, nationwide gas is $3.50, and that's flat year over year.
Okay.
In California, it's $4.80, a 40% premium for the privilege to live here. And
in San Francisco, what is it?
Oh, it's a big five handle, that $5+ Yeah. So, and to your point there, in 1981, when gas was like $1.35, I looked through a few things. If you actually adjust it all the way and you get it to current, it's probably more like $4.50 that it would be. But one thing to keep in mind, this goes back to technology improvements. Okay, in 1981, if I were driving my Ford Pinto around at that time, I'm getting 15 miles to the gallon. Today, if I'm driving the average vehicle, not an electric one, my average vehicle, I'm getting almost 30 miles to the gallon. So I'm actually I can go a lot further on a gallon of gas, and inflation adjusted gas is versus actually right now, it's actually a little cheaper. But it's still, to your point there, what is bothersome is that people in the lower, the lower income people, half of their income is spent on food and gas. That's why it's so important that administrations need to keep those prices down.
Right. And I guess at some level, you can't squeeze those making it paycheck to paycheck anymore. There's a point in which they stop buying gas.
Exactly. Or
they don't rent and they have to move in with family or whatever. There's a point which you can only charge so much, which brings me up to the next topic, home sales.
Yep.
And if you look at the difference between what homes are selling for and what you could rent those same homes for, there's a huge disparity, probably bigger than what we've seen in a long time. And along with that, you have, while we're not experiencing a market recession right now, there are sectors always, and especially like in real estate, where there's a bit of a recession going on. I mean, if you're a realtor, you're feeling it. If you work for a mortgage company, you're feeling it. If you do a home appraisals, you're feeling it. Like there are some people that are really just barely making it paycheck to paycheck in their given industry, just waiting it out, hopefully to survive, until it comes back. What is your thoughts or feelings about home prices slowing, if that would affect the general economy, and maybe clients who are looking to purchase a home?
Yeah. So like inflation that has impacted the price of food and gas, home prices have not been spared that. I think from pre-COVID, home prices on average, they're up 50%, 50. So if you own a house, you're like, yahoo. If you want to buy a house, you're like, have I missed out? So the affordability, as you mentioned, right now, it's very unaffordable to be able to buy a house right now if you look at incomes and the rate that would be charged. The mortgage rates are 7%. Now, bear with me for just a second. I had mentioned that the 10-year, which is at 4.25%, that's used to price a lot of things. It's used to price mortgages, and normally the premium, somebody's got to make some money. They can't, if their cost of the money, a bank's cost of money is 4.25, they can't just give it to you for 4.25.
Some people would beg to differ with you on that. Some people think you don't need to make money.
Yeah, exactly. That's a good point there. Boy, you're sounding like my kids. But anyway, that over time, it's 1.7%. That would mean that a mortgage should be 6%, but they're 7. There's this premium that's in it right now because people are uncertain on where rates are going. And the longer rates stay right where they are, the more likely those mortgages are going to go from 7 down to 6, which will be much more affordable for your clients that are looking to buy a house.
Which could cause some pressure potentially on the housing market now. So maybe being ready and looking, but maybe not jumping on. Maybe the right deal, I guess, is more of a factor than just because, the idea is like, real estate's been great. 30 years, prices of real estate always go up.
Yep.
You don't look at a statement every day of what your home value is. So you're not like, let's sell the house and get out of here.
Exactly.
It's gone down. But shoot, if I'm going to buy a house and my mortgage payment's $7,000 a month and I can rent an equivalent house for $3,500, there's a lot that I could save.
Ben, 100%. The way I've lived my life, I've got 5 kids, median age 16. So, and I tell them this every day. It's like you have to live within your means. Okay, so I can't tell people what price of a house they should pay for until they tell me what their income statement looks like. Once they tell me their income statement, I can say, here's a safe level of what you can afford to go out with. And, I wish that people would actually do that. Most people do that, but there are some people that try to stretch and hope that.
So you're not going to take a general liability of anybody listening on right now that you will back up any.
I'll backstop. Yeah, if they overpay for a house, I'll backstop. They can come down to main management, and we'll go ahead and write up a check.
Which, just for clarification, in case this gets sniped out in like a clip, he is not saying to go buy or to sell your home. It depends. It's an individual
decision. It's an individual decision.
And it might matter like where you want to raise your kids, and a home is a longer term decision. But if you're thinking about it from an investment standpoint, maybe you would think that being patient might serve you well.
And historically, home prices, they are a hedge against inflation. If you look over the long term.
For sure, yeah.
They're a hedge against inflation. So that's what you should look at there. Stocks, they should give you 9%, and then maybe homes are giving you 5%. And inflation's 3%. So that's kind of what. But you get a utility. You get to live in a house. You can't live in a stock.
I did see a commercial that told me I could probably double my money in a crypto, maybe a crypto strategy or something like that.
Yeah.
My friend's doubled his money, although he told me he only invested $500, and I told him he could just work a couple extra days. But so obviously. Being really realistic about your situation and if you are investing, maybe looking at your personal situation, if that's the right decision or not.
Yep.
All right. So I got to get to the national debt.
Oh, yeah.
Look, we can pick on any president. It's risen every presidential cycle, and I love people that want to point out, as maybe Trump supporters point out, how much it's risen under Biden, but it rose under Trump, it rose under the president before that, and so on and so on. So we kind of all know this. This is not like news unless you're maybe a young teenager and you're just not following anything. When do people actually start to care about the national debt, or when does this become maybe an issue in the markets?
Yeah. So like you said, Washington, D.C. has no advocate to stop the national debt from rising. The Republicans and the Democrats both keep spending. There's no advocate that says, hey, stop, you guys. So you are exactly right. This is a partisan issue, a bipartisan issue. So there's 2 things that I look at. The first thing is, remember, we're on a run rate for $1 trillion of interest expense. That also means somebody's receiving that $1 trillion, right? And in this case, it's mostly baby boomers. And they are out spending like there's no tomorrow. So there actually is a stimulative effect that happens on it. I know people, will kind of brush that aside, but it is true. $1 trillion of interest is being spent right now, and most of that goes to the baby boomers. The second thing to your question there about when does it become an issue? It becomes an issue when we cannot service the debt, okay? And right now we can service the debt. There's crowding out. You're going to have to, make allocation changes there. But it's pretty simple to look at an example. Japan's debt to GDP is 2.7 times, where ours is 1 time. You would think that if that was a problem, their interest rate should be well above that 4.25% I mentioned. They're not. They're at 1%. They're at 1%. And the reason why is because as long as they can service that debt and pay for it, it's not a 911. It's not a 911.
Right. Well, and I think you can say, obviously, Japan's they haven't gone bankrupt.
Exactly.
But that doesn't mean that there's not a problem. Obviously, there's issues with their dollar and
their currency has collapsed.
Yeah,
exactly.
But it hasn't affected. They're still operating.
Yep.
And so I guess maybe you could say this is a situation that the can be kicked down the road, and would it be our lifetime or our children's lifetime, or who might it affect?
Yep.
Listen to your friend Robert Heller.
Oh yeah.
One of our former Fed chairman,
governors,
talked about his experience in the 70s and 80s. And he kind of paints a pretty dire picture.
Yeah.
But like you said, Japan is over 2 times what we are.
Yeah.
And they're still operating. So it'll be interesting to see when that actually starts to matter. In the meantime, we're all tied into this together.
Oh yeah.
And maybe at some point have to understand that no matter how smart or conservative you are with your money in the bank or whatnot, that this could come crashing down on you, even though you're trying to be.
You're exactly right. And the biggest place where it will manifest itself is like Japan, it'll be in the currency. Japan's currency has, it's down 60% in the last 15 years. So it's been kind of a slow, drop there. But right now, because we're still servicing, we're only at one time. If we continue to expand that and we can't grow our economy and have the economy grow faster than our interest payments, then our currency will come under pressure.
It seems like when the economy starts to slow, there might be a move more to fix it. And that could be dangerous, of course. So going back to the comment you made about the baby boomers, because I work with baby boomers, a lot of them, and there's, except with the exception of a few, nobody is comfortable seeing their money dwindle down to the last dollar while they are alive.
Sure.
Even if they have Social Security or a pension, everybody always wants a little bit of money, and so there could be a pretty large transfer of wealth between, we know. Between the baby boomers and the next generation, where the next generation is largely known that a lot of them don't have enough to survive. But there could be a lot of inheritance passed on over the next, 20, 30, 40 years. And maybe even continuously if becomes where families are passing on money from one generation to another.
Yeah. Well, there's what, 150 trillion of net worth in the U.S., of which 76 trillion are the baby boomers. And you know this better than anyone. A big chunk of that, the big transfer, is going to happen to females from that baby boomer, because the females typically live longer, right? They've got a longer lifespan. So that first intermediate step, there's all kinds of work that's been done out there. Citicorp has done a bunch of work around this. And a lot of those people, they haven't grown up with the financial expertise. So they're going to need advisors like you when that happens. And then there'll be further transfers, like you're saying, over time to their kids, which are millennials. And it just keeps going. So there is a big bucket of money sloshing. But that's also why this economy, the service side, is so robust. Those baby boomers, they are spending. They got a lot of money, and they're taking cruise ships. They're taking airplane flights over to Europe. They're eating out, and our service economy is booming because of it.
Yeah, a lot of good restaurants to choose from.
Big time.
Yeah. And I guess we could thank the baby boomers for that.
Big time.
These are the same baby boomers who probably grew up and never ate out.
You are exactly right. Remember, a lot of these came out of, they had, Depression era parents, and then they were born right during the Depression. And so you're exactly right.
Or they raised their kids never eating out. I mean, I can remember growing up the special treat of going to McDonald's.
I bet you and I grew up the same way.
No Happy Meal, by the way. This is like, we're all sharing fries. You can get a burger.
Yep.
There was it wasn't like the value menu. And now, as the plight of, as tough as it is for people in the lower income class, eating out is kind of a regular thing.
Exactly.
Yeah.
Yeah. Food from away from home, you look at those charts, it's exploding. And then obviously food delivery to homes is exploding too. So that whole convenience factor.
Yeah, Mike, you have kids.
Oh,
I
yeah.
have kids. And the idea that one of the kids suggests, this DoorDash,
Exactly.
the food here. And I'm like, you got your driver's license.
Go get it.
Yeah, well, go get it.
Exactly.
It's funny. It's like all of a sudden they're not hungry anymore.
Yeah.
And
Amazing how that works.
yeah, it's just an interesting environment. And then of course, as much as the tipping culture is out of control, a lot of young people, they don't even tip.
They don't. You're right. They don't.
That's a little off subject. Let
Yeah.
me pick your brain
Yeah.
for your this next topic, which I want to make sure we fit this in for sure. A big topic is artificial intelligence, AI, and people are afraid of it.
Yeah.
Like I'll say to some extent, the biggest hassles I've experienced so far is my phone not understanding what I want based on maybe analyzing what other people are saying.
Yep.
But I haven't had any of my computers or machines in my house or my car take over all of a sudden and not let me have control. So what do you see for AI as maybe on our daily living, what we might expect, and then how that might affect the markets and your decision making?
Yeah. So I look at if you go back to 1995, the early 90s with the internet. Okay, that was kind of the first kind of tech cycle piece. If we look at on a like a 30,
Windows 3.1 or something like that. There you go.
Exactly. And by 99, there were only 30 million people on the internet. 30 million. Okay, 30 million. Today, we have 5 billion with a B. 5 billion out of the 8 billion people are connected to the internet. And then smartphones, there's 7 billion smartphones out there. So if you start thinking about the addressable market with AI, how people can access it, it's a whole new world. And again, I look at artificial intelligence as a productivity enhancement, as a tool to help things out. So if you are think about the ability for medical delivery. Right now, there's all these urgent care centers, right? That you're supposed to be a first line of defense instead of going to the emergency room, which is exceedingly expensive and eats up a lot of the GDP that we have.
Besides that 8-hour wait or whatever it is.
You sit around and you wait. If you've got AI that can sit down and you can do a lot of this Zoom style
Telemed, yep.
Telemed there, and it's got a database that it's looked around. And let's say one of my kids has a rash on his hand, and so you get on Zoom and you show the rash to the nurse practitioner, and the AI says it goes through and it's grabbed data from all around there, and it's like, we've seen that rash a gazillion times. Here's the 2 most likely things that it is. Here's a topical cream that you can put on, or maybe it's something more severe and they're like, we need you to come in here. That is going to be a game changer for a lot of people for medical, and that's just one area. I think each of these areas, those sectors of the economy that we talked about, energy, drug discovery. If you're looking on the drug discovery side, there's like 3 years that it takes for the government, the FDA, to read all these trials and try to figure out what's going on. AI can take that and go from 3 years to 6 days, and that they can be able to compress it. So what scares people on AI is they think that their job is going to be displaced. And it is true, because previous technologies they typically do displace jobs, but they're jobs that are very low on the totem pole and kind of mindless. And they're replaced with higher value jobs, much more skills. And think about today, in the old days, you'd have to go become an intern and train under an electrician to maybe train yourself. Now, with online capabilities, you can probably bring yourself up to speed much quicker.
There's nothing like going into a particular service of any kind and having a very simple question and having to wait behind a line of people with very complicated questions. The idea that maybe we can utilize computers or in some
Yep.
way to help us get, these simple questions answered without having to wait behind
Oh,
other people who are.
it's so.
Yeah.
And one other thing, I'm stealing this. There's a gentleman named Tom Lee from Fundstrat. He does
Yeah,
some
I
very,
love Tom. I listened to him all. Yeah.
great work he does, right? So his big thing he's been talking about from 2015 until 2035. So this 20-year sweep. In spite of what people think, there is a shortage of prime working age people. So this is age 25 to 54. Globally, there's going to be a 40 million shortfall. And a lot of that because birth rates are collapsing everywhere, right? China is not replacing. China's been as a declining population.
Well, maybe a demand for more services as well.
100%. And so what he thinks will happen is when you have that 40 million shortfall, you have to replace it with something. It's going to be with some form of productivity, some form of a chip, some form of a machine, a robotics, et cetera. All of it goes back to technology. All of it goes back.
An employee that runs, $50,000 to $80,000 a year, I can now spend $100,000 and have it covered for the next 10 years
Exactly right.
and updated.
That's right. That's right. And that's why and that's why Elon Musk talks about his Optimus. That's his robots. He thinks he could be doing $1 trillion. That's $1 trillion a year in profits from his robot division.
It's going to come from the labor that we're not able to get
100%.
and or the shrinking labor force. And you're talking about companies who expense that right now.
That's right. And that'll create people for new industries for servicing those robots, programming those robots, making the parts for those robots. There's all kinds of jobs that'll be created.
So you've heard it right here. Put every dollar you have into Tesla's Optimus robots. No, obviously, I can see that being a potentially very lucrative. Of course, we know there are people who are first to the game, and then there's those who outlast everybody else.
Right.
And sometimes there's a great idea funded on great principles, but the execution isn't always there.
Oh, well, Ben, think also on that part there. Google was not the first web search, right?
Web crawler, right?
Exactly. There were all kinds. There was Netscape. There was
Netscape,
all these other ones. And you go through. Apple was not the first phone. They were not the first. There was a Palm. There was other. So being first doesn't always mean that you're going to be right. There's iterations that happen along the way.
MySpace versus Facebook, and
Exactly.
I would also point out. You brought up. I apologize. I just got a brain loss.
I'm supposed to have the senior
processing
moments.
what you just said.
Yeah.
Yeah. Actually, I always feel like sometimes when you come up speechless, it's because you're listening.
Yeah. Exactly.
I could just ignore what you're saying and be ready with the next question.
I agree.
But what I was going to bring up is you brought up 30 million in the first internet cycle back in 1995.
Yep, correct. 95 to 2000.
I've met some of these folks, and the way I know them is they have the AOL email still.
I love it. That's
Talk
exactly
about
right.
committed folks. Because I've had to leave a few emails because of the amount of spam I get.
Yeah.
You're talking about some real committed. Those are the kinds of people I want as clients because once you get them,
30
they're never going to be leaving.
That's
they're
right.
They're for life.
I love it. That's great. That is good.
Okay. Shoot, we have just a few more minutes, but I do want to get one more. Maybe what you're excited about in the future. Maybe we'll leave on a nice positive note.
Yeah. So, couple things. The first thing that I'm excited about is to steal from Warren Buffett. I still am a big bull. I'm very positive on American exceptionalism. I still think in spite of all these things that happen out there, we've got the best form of capitalism here, the best ability to raise everybody's standards of living and continue to produce things that people want. So
Not perfect, but
not perfect by any stretch there. There's always room for improvement, but I think you have to look at it on an absolute and a relative basis to what other people are doing. And right now we're leading the technology charge in AI. We're leading the technology charge in semis. We're very, strong in software. So those key building blocks we're very, very good with. So I'm very excited about that. And the other thing I'm excited about is advisors like you with the businesses that you're building, you're going to do the right thing for your clients to make sure that they have exposure to these AI trends. They have exposure to these big themes that are going to be really growing. They're disruptive technology, and they're also kind of pervasive, and they're early in their life cycle.
Well, I appreciate that. Obviously, we're not fortune tellers, but
Sure.
we certainly, like you were saying a lot, look at things from a historical standpoint, which is really the most you can do with it.
Exactly.
Anybody who predicts that they have a new method outside of stocks, or that they could somehow know the future, it's probably something to be a little cautious about moving
Yeah.
forward. And this is great. I'll tell you that I really enjoyed this conversation with you. You're obviously a very smart individual. I know that's not what you're trying to tell people, but it is evident. And I also know, which my listeners don't know, is I know a lot of people at the company,
Yeah.
and I've met very, very smart individuals. Just surround yourself with a lot of smart people, smart pieces. And so I'm very happy to use you guys as one of our options in our portfolios. So hoping that maybe we can do this again sometime
Love
in the
to.
future. Thank
Would
you
love
so
to.
much,
Yeah,
Ken.
no, Ben, thank you. And like you said, I shout out to my whole team, the 22 people that we have. We've got a phenomenal family/team, and we love partnering up with people like yourself.
All right. Appreciate your time. We'll hopefully, do you have a disclosure you would like to share? Go ahead, Ray.
Well, thank you. This has been an extraordinary conversation, and I'm sure we could go on for many more hours of this. Ben and Kim would like to thank all of you for joining us. More info can be found at www.astutewealth.com and www.mainmgt.com. You are also welcome to send comments or questions to me, Raymond Minkus, at rdm@minkuspr.com. And please remember, very apropos of this conversation, comments made and opinions offered herein were of a specific or of a general nature, and the content of this podcast may not correlate to your specific tax, investment, or wealth development strategy. You are advised to contact your own accounting, tax, or investment professional before making decisions and taking action based on the information provided in this podcast.
Thank you.